Hi guys, so this is George Atento from Innovizon Creative Solutions and Dream Channel TV. And our topic today is about inventory management. So these are your introductory concepts for inventory management. There's a reason why not a lot of companies, not a lot of training companies do inventory management concepts. And the reason is every company, every industry, in fact, every company has different inventory management techniques. Okay, so especially if you are in manufacturing sector and the way you deal with inventory, of course, it's tied up with accounting. Um, Also, the way it's dealt in your system, if you have SAP or QuickBooks or whatever it is that you're doing, then the differences in handling the accounts in your accounting system, sometimes they do define the type of inventory management that you have, because the controller usually is an accountant or CPA and usually the one handling inventory, maybe from business or sometimes from computer science or other stuff, other industries, and sometimes even from engineering. And that's the reason why some confusions occur, especially if there's a difference of opinion, difference of belief in the way we handle inventory. So that's the reason why not a lot of companies offer inventory management courses, but in the sense that we are going to handle it in an overview mode, or in the sense that we are handling it schools would handle it, so we're pretty much okay. So yeah, without further ado, let's look at the origin of the name inventory or inventorium in Latin. So it's a word that originated in 1375 to 1425, late Middle English era. So it's been around for 500, 600 years already, right? And so far as the start of the industrial revolution of the 16th, 17th century, we have already the concept of inventory, right? It started with mercantilism, the way merchants would handle their goods or their products. Then that's the way inventory management evolved. Yeah, so the aim of this presentation is to introduce the topic of inventory management to an already stressed, hard-pressed, and unsuspecting class of students. I like this. In reality, our aim is really to make broad strokes of introduction for students who are of different industries, of different uh, understanding, and basically of different practices. So there are things here that will be different for each and every one of us. So it is really up for the student to understand it and apply the concepts in their companies. So that's something that we need to understand early on. Okay, so in this slide, we talk about the scope of the presentation. We have part 1, basic concepts, part 2, systems and methods, part 3, miscellaneous aspects, and then we will have some interactive session and conclusion. Of course, the interactive session would take part in the learning management system, the canvas, as we presented to you in the beginning. And I must make this comment from the get-go that the success of this endeavor, of these sessions, is really going to depend on the way we create some knowledge and interaction, especially on the grounds of the differences of our practices. Okay, so I know that it will be difficult for everyone to understand in the way their classmates or their peers in the seminar understands the concepts of inventory management, especially since you are of different industries and different companies. But let's just take into consideration the way the concepts are presented here, and then try to make the application in your company. All right, so without further ado, the first part is about the basic concepts of inventory management. Okay, inventory in financial accounting, we will take note of the assets that are held for sale in the ordinary course of business or in the process of production for such a sale, or in the form of materials that are to be consumed in the production process, so these are your raw materials, or in the rendering of services. Of course, the relevance would be either the trading concern or the manufacturing unit. So it can be uh, understood from the point of view of retail and the point of view of manufacturing. Of course, we also consider the loose tools versus the spares. Okay, we have types of inventory. Of course, the vendors come in and give us the raw materials, and then there are work in process. These may be some production units, and these are all considered to be inventory. And then afterwards, we have the finished goods before it's delivered to customers. Again, these are also inventory. Okay, so as presented, we have the types of inventory are the raw materials, the basic inputs that are converted into the finished product through the manufacturing process. It can be the work in progress, the semi-manufactured products that need some more work or before they become finished goods for sale. So it can be in the uh, can be at the point of labeling, in the point of finishing. For example, all the production processes have been accomplished, but then there are some finishing or sometimes labeling, and then sometimes the finishing. If in the case of painting, different colors would do, and then the packaging. So these are also considered. And then, of course, the finished goods that are completely manufactured products and that are ready for sale. Supplies, office and plant cleaning materials that do not directly enter production but are necessary for production process and do not involve significant investments. So these are also considered inventory. So again, as I said in the beginning, um, the way we understand inventory would basically be influenced by the way our accounting system or accounting policy understands what inventory is. So because some companies would not consider, especially these ones, example, cleaning materials, plant cleaning materials. Some companies would not include that, and they would directly be included as expenses. And some form part of the operation expense. Some form part of the cost of goods, especially if you are doing some, the perpetual type of inventory, right? So it really depends upon the way the company understands inventory. Okay. So the relevance of inventory, it constitutes significant part of current assets. Again, depending on the accounting policy, sometimes the controller would look at this from the managerial accounting perspective and look at the balance of the inventory as a percentage of total current assets, or sometimes even total assets, because that's the way they balance out uh, whether they have enough inventory for the next couple of weeks or even months. Sometimes, especially in the food sector or food preparation sector, you will consider uh, the number of days before the food becomes, you know, stale, right? Or the cycle time, depending really on the type of inventory that you have, right? Especially in your if you're from the merchandising sector. So the concept of current assets enters into the fray. So current assets are realized or consumed in the operating cycle. Current assets also considered to be held primarily for trading, okay, or cash or cash equivalent. So really, again, this all boils down to the type of accounting policy that you have and the way you understand current assets, especially if you're from the services sector. So if you're from uh, a school setup or if you're from a services setup, there are assets that may well be considered to be inventory in other industries, but in your case, it's just facilities and equipment. And really, when you look at inventory per se, then it may not be inventory. I mean, from another perspective. So really, you have to make an agreement or form an agreement with the accounting department on the way you would understand inventory as part of current assets. So as is included here, an asset which is not a current asset is a non-current asset. So that's how simple it is. So the relevance inventory, it constitutes significant part of current assets as mentioned. On an average, and of course this is from the perspective of India, 60% of current assets in public limited companies are inventory. So again, it really depends on the way we understand inventory. So this is just a benchmark from India, um, and usually this is understood from their accounting system, the way they do the reporting in the accounting system. So of course, it has huge financial implication. Effective and efficient management is imperative to avoid unnecessary investment, of course. Improper inventory management affects long-term profitability and may cause failure ultimately. Yes, especially if the company is not into what we call the lean management concept, wherein in Japanese terms, you have what we call just in time or Kanban, wherein you only have the inventory when it is time to use it, or as is the concept of just in time is. So the concept, of course, is deeply rooted in the idea of lean management, and also the what we call the demand pull, or the pull concepts of the demand. Because for example, in the company that I work in, we don't believe in push marketing, we believe in pull marketing. So in a way, we don't push the product into the market, we wait for the demand to come from the market to pull the product from us. So all these are part of the understanding of the company in the way operation should proceed. And that is the reason why I said that for every company there's a different inventory management understanding. So 10 to 20% of inventory can be reduced without any adverse effects on production and sales by using simple inventory planning and control techniques. So inventory planning for the Japanese companies would focus on the average demand, the pull, so-called pull. And the control techniques does not just consider the cost, of producing, but also balancing out the totality of the facilities that we have, the uh, output and efficiency, how many people should work there, what would be the average output per day or sometimes per shift even. So all those things are planned way back, from the very beginning of the company, because everything has to be planned. If not, then you may be overproducing or sometimes underproducing, especially if the market demand grows stronger. So really, all this is, concepts. All these concepts are tied up to strategic planning, human resources, and even accounting or financial management. So inventory management is the act of managing, handling, directing, and controlling the flow of inventory. Again, this is tied up to operations management, tied up to quality, and all that. So the need is, it can be demand related. This is somehow clear from what I said just a slide away. Demand related. So why is it demand related? Sometimes you do your inventory management because you want to meet unexpected demand. Sometimes there's an unexpected demand. Like for example, I know of a certain company in Batangas that uh, have erratic demand schedule, especially if you are producing for the need of an industry, like for example, construction. So one example, I'll already name the company, Mariwasa Manufacturing in Santo Tomas. They produce tiles, right? So they would tell me when the last time I visited them that sometimes when SM Development Corporation would suddenly, give them demands like, okay, we have a high-rise project in the area, and I need something like, a million tiles or something like that. And easily you cannot produce this at such short time, notice. And so, in order to meet the unexpected demands, they would be forced to import from Thailand. And now, of course, you have to balance out handling, cost, the wear and tear of materials. Do you have enough space in the warehouse? Those are the things. And this is demand related. And of course, you cannot produce at a high rate because sometimes your capacity has to be considered. We also have seasonal or cyclical demands. So this is really the work of the operations manager. But if you are sometimes in companies, you have one person in the inventory or procurement, and you don't have enough data to to create your aggregate planning, then that becomes a problem, right? So really, there are demand related needs. Sometimes escape your forecast, your planning. Okay, so that's okay. I mean, that's a good problem because this is demand related. Now, it can also be pricing related. Clearly, it can be a hedge against price increase. Like for example, you know that certain goods or certain supplies would uh, increase in price next month or next 2 months or next quarter, then you would stock up on your supply. So this becomes just in case, not just in time, just in case the price increase. But sometimes the price increase is really inevitable. And if you compute that, pending, you know, uh, the the level of demand in your goods, right? With your goods. So really, you would stack up on your supplies just because you don't want to be overtaken by your price increases, right? Another one is pricing related is if you want to take advantage of quantity discounts, right? If suddenly a supplier would give you discounts for 100,000 units or 500,000 units, and all you need was, I don't know, 60,000 or something like that. And sometimes you would stock up on your supplies because eventually you know that it will be needed, and now you are going to balance it with your handling and the wear and tear, again, the space. So those are the things. Another thing is to consider process and supply surprises related. So internal, there are upsets in parts of our own processes or upsets. There are delays. Sometimes you don't foresee the breakdown of your machines, right, of your equipment. So that's internal, and those are surprises that you don't know about, right? So usually you move your inventory considering those things. And then there are also externals, delays. This is really part of the computation, delays of the incoming goods, delay on the part of the supplier in delivering the goods, delay in the part of customs, the process, right? So those are external. Objectives of inventory management is to maintain an optimum size of inventory for efficient and smooth production and sales operations. So if you will notice, even in the POM software, there are a lot of assumptions that we will have to follow. Yeah. So to maintain a minimum investment in inventories to maximize the profitability. Of course, in the long run, you don't really see this because again, it depends on the way your company sees inventories. Again, from the perspective of lean management and lean accounting, inventory can be considered as, too much inventory, of course, is considered to be a liability because you have to maintain it. It's in your office or it's in your warehouse. You have to guard it. There's a risk of, the wear and tear, it can be stolen. Those are the things that you have to look into. Effort should be made to place an order at the right time with the right source to acquire the right quantity at the right price and the right quality. Yeah, that's how difficult inventory management is. Success mantra. Okay, so this looks like a Buddhist mantra. Ensure a continuous supply of raw materials to facilitate uninterrupted production. Yeah, very ideal. Yes, especially when you do lean management, there's such a thing as value stream, and usually a continuous supply of raw materials does not happen. Okay, but it would be ideal because if not, when raw materials suddenly stop, then your employees are there. There's nothing to do. Okay, maintain sufficient stocks of raw materials in periods of short supply to anticipate price changes. Yes, this happens a lot considering the almost impossible to project or forecast pricing in the world market, especially. Uh, Maintain sufficient finished goods inventory for smooth sales operation. Yes, from the side of sales and marketing. Efficient customer service, of course, if they need that, then of course you have to deliver it, right? Minimize the carrying cost. Yes, it's part of the computation of EOQ and all that. Control investment in inventories and keep it at an optimum level. Yes. Um, Again, there are companies that employ Kanban, um, certain percentages of inventories versus the current asset, as I mentioned. So that can be considered as the success mantra of inventory management. But what if we overreact? So um, it can result in excessive carrying costs. And so, especially in the US, this is really a problem, right? Well, of course, in the Philippines is also a problem, especially because goods are often, they are coming from other countries and they have to cross the borders, and there are a lot of things to consider: the currency exchange, handling, carrying, those things. Risk of liquidity, difficult to convert into cash. Yes, especially if there's a sudden downturn of the of the economy. You have a lot of goods, it's difficult to convert it to cash. Physical deterioration of inventories while in storage. Yeah, so this is really the thing that lean accounting or lean management is avoiding. Okay? What if one is too cool? Production holdups, if you're too cool, production holdups, loss of labor hours. Yeah, so if you're too cool, you don't order inventory, then you will lose a lot of labor hours. As I said, there are people waiting to work, but then there's no inventory, so they stop working. Failure to meet delivery commitments, yeah, especially if the inventory is held up somewhere, especially in customs, then you are unable to process it. You are not able to also deliver it with your customers. Customers may shift to competitors, which will amount to permanent loss of the firm. Yeah, so that's how difficult uh, inventory is. It may affect the goodwill and image of the firm. Yeah, especially in companies that are really focused on customers. Like for example, schools, right? Uh, the way we process our products, our inventory, from the side of the students, especially if it is being used for instruction, uh, and the subject is already in the midterms, and you have not delivered what should be there from the beginning of the course. Yeah, so that's a problem. So in a nutshell, we track inventory, how much to order, when to order, and then if we know the value, all these functions will get addressed. So it's really hard. Sometimes it's even harder in other countries because of terrorism. Okay, so we have part two, the systems and methods of inventory management. Okay, so these are some of your inventory management or inventory systems. And from the left side, we have the factors. Factor is basis of ascertaining inventory. If you are doing the periodic inventory system, then you're doing it by actual physical count. If it's perpetual, on the basis of records, which is really based also on the physical count. But this is more of computerized accounting. Okay, another factor is the calculation of inventory. For periodic, it is directly by applying the method of valuation of inventories. Okay. Uh, Now for perpetual, it's computed this way. So closing inventory equals the opening plus opening inventory, and then you have the purchases minus the cost of goods sold. Yeah. So for periodic, really, if you will look at the difference between the two, periodic relies really on actual physical counting at the end of the period. Calculation of cost of goods sold. Yeah, this is really accounting, right? Cost of goods sold is equal to the opening inventory plus purchases minus closing inventory. Uh, so for perpetual, this is directly calculated by the method of valuation in inventories. So really, if you look at perpetual inventory, this is actual cost of goods, especially if you are using SAP and those accounting software. Lost goods, periodic inventory system, the cost of goods sold includes cost of lost goods, okay, if any. So for perpetual, the cost of closing inventory includes the cost of lost goods, if any. So we will see here that the perpetual looks at the cost of the lost goods at the closing inventory. So that's all charged in the system. But no matter what happens, it's usually charged, of course. Depends when it's being charged. It's either in the closing inventory of the period or um, during the time that it's sold. If there are, of course. So for methods of valuation, an inventory valuation allows a company to provide a monetary value for items that make up its inventory. So this is just the valuation on the accounting system. So some of you may not have need for this because you're not in the accounting, but nevertheless. So methods, sometimes it's first in, first out, FIFO, or last in, first out, LIFO, or weighted average cost price overpriced method. So it really depends on how your accounting system would work. So for FIFO, this is based on the assumption that the goods that are received first are issued first. So first in, first out. This is logical, right? So for purposes of assigning costs and not exactly for the purpose of physical flow of goods. So usually we are using the cost in terms of the concept of first in, first out. It's not really the case, right? But this is really more of assigning costs and not considering the real the flow of goods. Goods sold thus consist of the earliest lots and are valued at the price paid for such lots. The ending inventory consists of the latest lots and is valued at the price paid for such lots. Balance sheet shows ending inventory costed as per approximate market price. So usually this is being computed. So the understanding here is that if you bought goods on day 1, day 2, day 3, day 7, day 10, day 12, day 30, so there are attached costs to them. And since it is first in, first out, then it really depends upon when it's going to be sold. And you're assuming that the goods that are coming out first are the ones that are bought first. Yeah. Yeah, so this is not an accounting seminar, so we will avoid the computation. But now we go to the LIFO method. The LIFO method is based on the assumption that the goods that are received last are issued first. Okay, assumption is made for purposes of assigning costs again and not for actual physical flow of goods. So the flows of goods and costs may not coincide, as in the case of the FIFO. So a goods sold thus consists of the latest lots and are valued at the price paid for such lots. And then the ending inventory consists of the earliest lots and is valued as such. Balance sheet as an inventory costed at old prices. So yeah, I don't know whether your company is doing LIFO method. Usually it's FIFO, and well, there is also some understandings or also some wisdom to doing this, because if you do this and usually it's a rising cost or rising prices, then you are under declaring the inventory cost held. You're assuming that if there's inventory that are in your warehouse, it may be the old prices, it may be the old inventory. So you are not aggressive in this case. You are conservative in putting old prices. But of course, in the real sense of inventory, of operations management, considering the actual physical flow, then it's really FIFO, right? But again, it depends on the way you understand uh, your, the method, especially considering your accounting system. Okay, so now for weighted average price method. This is based on the assumption that each issue of goods consists of a due proportion of the earlier lots and is valued at weighted average price. Maybe this is mathematically sound or better even than the first two. What you do here is to average all the prices, so that you will know more or less the cost of each good based on the weighted average method. So the weighted average price is calculated by dividing the total cost of the goods in stock by the total quantity of the goods in stock, right? And of course, you will have the total value divided by the number, then you will have the average cost. This weighted price is used for pricing the issues until the new lot is received, when the new weighted average price would be calculated. Okay, so when there's a new inventory, then there would be a new weighted price. Again, as in the case of even FCDU, foreign currency denominated units, when I was working in the bank, this is the way it's done. Okay, we have a value at the beginning of the month for dollar transactions, and then at the end of the month you revalue it, and then you apply the cost, and then you carry it forward to the next month. So this method evens out the effect of widely varying prices of different lots that make up stocks. Okay, so for better understanding, we have here, for example, the units available opening inventory is 100. per unit cost would be $2.10. So the total cost is 210. Then there's a sale at 75. You don't value it yet. And then there's purchase of 150 at the cost of 280. Then there's a cost again. So you are counting the total cost. Then there's a sale. Again, you don't value it. Purchase was 50 and it's valued at $3. So the total cost is at 150. And then you have the total cost at the end, the ledger, and then you divide it by the total units available, um, considering the units sold. So 300 minus 175, that would be your ending inventory. Yeah. Okay, welcome to part 3 of miscellaneous aspects. Okay, so we have here classification of inventory. Again, it depends on your company, right? So we have ABC classification. This is based on consumption. Like for example, you have 25 at 80%. So these are your percentage: 80%, 15%, and then 5%. So it can be that based on consumption, 80% are doing this, or are buying this, and then 15% are buying this goods, and then 5% is buying this goods. So we have ABC. We have this also in POMQM. So let's we will understand this better. XYZ, these are values stored. So high, medium, low. HML, high, medium, low. It can be unit value stored depending on the way it's understood. So usually grocery store, supermarket can also be doing this, or uh, where what's that? Uh, Warehouses, or yeah, uh, factories even, right? VED classification. It can be spare parts, so vital, essential, and desirable. So it can also be considered ABC, but some some are really the way we consider inventory. So this is just classification. So you can even do your own, right? FSN, fast moving, slow moving, non SOS, seasonal or non-seasonal. So it can be in agriculture. SDF, availability is scarce, difficult, or easy. Golf classification, whether it's considering the supply, the source of supply, government, ordinary, available, local, and foreign. Right. So this can be some ways to classify your inventory. Okay, so these are emerging trends in inventory management. This is not really emerging. This has been around for a long time already. But some trends in inventory management involve entering into long-term contracts at fixed price. Okay, so usually you can do this if you have the relationship already with your supplier. So it can be long-term contracts. You already know the price, fixed price, in order to reduce uncertainty, especially when you are price sensitive. Just in time, of course, in Gene, Kanbans, okay. Just in time and Kanbans are also connected. Only produce when the demand comes. I already discussed this. Internet-based ordering systems, yes, we have this already. SAP is interconnected now, and you can do it using the web. Supply chain management, of course, this is either easily done using advanced software and even cloud computing. Vendor development, there are vendors that do this, which includes also their suppliers. Again, SAP can do this, especially now using cloud computing. Investment in plant and machineries. But of course, these are not emerging trends. These have been around for a long time already. Okay, so finally we have inventory control responsibility. Purchasing naturally has best interest in inventories, even to the extent that in some companies, purchasing and store functions are controlled, right? So in effect, all these inventories are economic importance, sub-economic importance to finance department. Of course, also the fact that materials must be moved from one place to another is of importance to materials department. But in effect, the responsibility cannot be kept in one head, since inventory management is an integrated effort. As I said, it's really part of the bigger operations management. Yeah. So that's it. Any questions? Okay, none. Bye. Okay, we see you in the next video when we start computing, especially with some problems considering economic order quantity and the best quantity point of ordering. Thanks for listening.